we had a lot of people talking about how winter was over, and we did have one of the warmest Christmases in a long, long, long time. So market, I think, gave up on everything. Positioning became pretty extreme to the short side. And I think this forecast flip over the weekend caught a lot of those people by surprise.
Welcome to the Energy Desk, a podcast from Mobius Risk Group. In this series, we break down the macro forces and fundamental trends shaping global energy markets. We cover everything from geopolitics and policy to supply, demand, and the price risks that we're watching behind the scenes. Each episode is designed to cut through the noise and give you clear, actual insight into what's driving today's energy landscape and what it means for what comes next. You can follow the show wherever you get your podcasts. You can share feedback or ask questions by emailing podcast@mobiusriskgroup.com. Let's get started. All right, back on the Energy Desk, round two, sitting here on Thursday, the 22nd of January. And we're enjoying a nice week, exciting week for natural gas. And we have our resident expert, Drew Boyce, in here today. So excited to have you on, Drew.
Hey, excited to be here.
So let's kick it off. We had, obviously, most market participants are going to be aware of what's been going on in the U.S. natural gas market, but also have some interesting developments for Europe and Asia and some interplay in between. I think maybe just kind of laying the ground a little bit for what's been going on. Friday to Monday have some massive colder revisions to the end of January forecast. And that trend continued through the week, had even more bullish revisions in today's overnight runs. So looking strong for end of January cold. Most of that going to be hitting South Central, Midwest, Plains, and up into the East as well. And many concerns related to both the combination of intense cold, but also ice in different areas. So today, prompt Henry Hub settled at just over $5, came off of intraday highs of over $5.60, and we can kind of dig into maybe why that happened as well. But is there any particular area that you guys want to kick it off and maybe start the discussion?
Yeah, sure. I would say the biggest thing is, and like you said, a lot of market participants probably are aware of what's going on and the cold that's out there, but how quickly it showed up in the forecast over the weekend. Usually we have 8 to 10 days to prepare for these. So you came in Saturday and Sunday, and Monday being a holiday in the market. So really Tuesday, Wednesday, end of day to prepare for what seems to be a large weather event going on right now. So, the biggest thing producers are worried about, not only the cold, but as you mentioned, the precipitation that's expected. So with precipitation means longer times to get production back up. So, a 2 or 3 day cold spurt will turn into 3 to 4 to 5 days, just depending on how fast ice and snow can melt. So a lot of concerns there on what production will do over this weekend. It is supposed to be really cold, kind of like, as you mentioned, in the mid-con and moving east. Texas, North Texas is kind of going to be impacted. South Texas is not going to be as impacted. Haynesville is supposed to take some hits, but those guys are pretty optimistic on where things will come in. Obviously dry gas, so less water there, so should be able to handle volumes more. It's been interesting what's going on in the markets as well. You mentioned we were at 560 on NYMEX today. Swing swap for the financial swap for the weekend was trading $18. It got hit down to $14. Part of the reason why February came off as well. So a bit overdone. As most people know now, LNG is up in the 20 BCF range. So we think some people were out there selling, potentially some LNG guys selling the weekend, pushing that thing down a little bit.
Yeah, bringing gas back to the domestic market.
Exactly.
Yeah, the rally that we had for a Henry Hub financial is definitely impressive. We were on track if we held today's highs for a record-breaking 3-day move, and I think we're going to settle as the second largest 3-day move since at least 2005. And we had just between the Tuesday, Wednesday. Those 2 days, we were up over $1.70 and up another 17 cents today. So definitely quite a big shift. Most of that was front centric. So, you know, we didn't really see a whole lot of change beyond 2026 in any meaningful capacity. But, maybe Mohit, what have you been seeing on the curve that's been interesting this week?
Yeah, I think a couple of things. I mean, just to take a step back, we had the early December rally, and then we had a lot of people talking about how winter was over, and we did have one of the warmest Christmases in a long, long, long time. Um, so market, I think, gave up on everything. Positioning became pretty extreme to the short side, and I think this forecast flip over the weekend caught a lot of those people by surprise. So that was part of the urgency because people were caught wrong-footed. And I think also just the whole sentiment of giving up on winter in December is, I think, a little premature. So
And that's something that we were highlighting early on in January, just this very, very, very bearish reaction to that December week warmth that we had, and then the subsequent relative warmth that we had for the first couple of weeks of January. We were highlighting the fact that, as you said, winter's not over. You had immediate storage concerns kind of come off, fortunately, from the December cold. So we had a little bit of a buffer where storage could tick back higher. That did happen. But just the sentiment shift with, really 2+ months of winter remaining at the time didn't seem to really match the distribution of outcomes or the skew that we were seeing at the time. And the interesting side of that, kind of corresponding to broader market sentiment, speculators were moving even more bearish, and we got into that kind of top quartile of short interest for Henry Hub through last week, through I guess it would be January 9th to 13th. So the top quartile there, and most of that was flushed out most likely this week. We'll get a firm update tomorrow. But as we kind of look forward without shorts in the picture, I think it may be interesting to talk about the kind of near-term, midterm consequences of that, and maybe the distribution of outcomes going forward. So either one of you, feel free to take
let
that.
me, let me start on the financial. I mean, talking of skew of outcomes, I mean, once you've gone from like, call it 310, 325 up to 550, you really need sustained cold to keep it up there and move beyond. So at that point, the skew actually is flat to more risk to the downside if the weather flips. And if the shorts are out, then who's left to buy it? They're not going to go short it right back after they cover it, and no one's going to come in to buy it $5+. So the risk is to the downside if you don't get sustained cold. Other things which were very interesting in terms of the first day, not a whole lot changed on the vol and skew side, but when we got the second day, then vols exploded to the upside, and I think they were even stronger this morning before the sell-off. So, and that was priced in the next winter and the winter following as well. So that's kind of what's uh, going across the curve as you asked. So it was very front driven on day one and then kind of percolated to the back.
Yeah, I would say too, at 560, people are looking at where February could price on in the cash market, and you're sitting here thinking, okay, January's averaged low threes so far until this pop. You have kind of 7 to 8 days of weather in the horizon, and then after that, February is expected to be back above average on temperature. So people are starting to look at that like, okay, are we really going to buy or 560 gas in February, even if there is a cold spike, even the cold spike that's expected in January, we're going to average probably slightly below that. So it'll be interesting to see where Feb shakes out. Obviously, this weather event showed up out of nowhere, and it can happen again. Last year, we had two kind of storms roll through in mid to late February. President Week is always a hot one to get us working on the weekends and doing that. So we always like to say it's going to be President's Weekend on a 3-day weekend, and another storm will come through then. But it definitely can happen late in February, so don't write February off either. That said, the forecasts are looking very bearish on the warm side after this kind of cold leaves on February 3rd or 4th next week. So it will be interesting to see how quickly producers can get production back online next week. And if they get that kind of back to normal levels before this cold kind of sinks in next Friday, Saturday, or if, a lot of these guys will only get up to probably 90% maybe, depending on where they are. And again, precipitation is really going to be important when looking at that. So it'll be interesting to see how next week shakes out and how that February cold sinks in the first couple weeks and how quickly it dissipates.
I think the long range forecast is always an interesting discussion, just because I think when we started December, the outlook basically started bearish and started bullish and got increasingly more bearish. And now we're looking in January, get surprise cold, and it can flip on a dime. But as you mentioned, the February outlook, as of right now, is showing that we'll most likely see moderate warmer anomalies basically for the south central and Midwest moving west, and then pretty mild cooler anomalies for the Northeast and kind of the eastern Midwest. So not looking super great right now, but I think that highlights the volatility and the unpredictability of forecasting, and is definitely not a guaranteed outcome. On the production side, I think maybe
Real quick on weather, Alex.
yeah,
It's kind of interesting looking at the forecast. I feel like the last few years, a lot of weather forecasters have been nervous to predict cold. They predicted cold this year, kind of 3 to 4 weeks out, going into December, and it blew up in their face. So, there could be some of that going on. I mean, we saw this cold front move in on Saturday, Sunday in the forecast, which is pretty quickly. So, our February, they're being more conservative than they really should be. It'll be interesting to see what shakes out as we move into Feb. If we get another kind of storm, once we get kind of roll into next week, you start to see more 2 weeks into February, and if you see some of that Arctic cold coming in, or if it really reverts back to heat.
yeah, that's a great point. That's a great point. And I think one of the other things that you mentioned, Drew, on the production side, so in previous storms, obviously pretty significant impacts. What are you hearing on kind of the street as of this weekend heading into next week? What's kind of a volume that we could see come off if that ice hits as expected in some of these areas?
Yeah, I mean, realistically, you're probably looking at a 12 to 16 BCF range reduction. It's how quickly it goes offline and how quickly it comes back is the big thing. Looking back to Winter Storm Uri, which everyone likes to talk about, you obviously had a lot of ice, a lot of snow, long cold. It wasn't cold for 2 days; it was cold for 4 to 5 days. So it has some resemblance to Uri. It's not getting near as cold as far south. So I think Houston, our lows are 25 and highs of those days are 40. During Uri, the highs were 12 or 13 degrees, I think. So you're going to see a lot less freeze offs for a lot less for probably less time than we did in Uri. Some other things that are going to impact that too on the freeze off production side. A lot of these issues around processing plants and midstream companies, what they did with their power during Uri, selling it back to the market. A lot of those issues have been resolved. We see those plants stay online for longer most times now, or at least the kind of events we've had since Uri. So I think some of those issues have got resolved. And then, looking at the Permian producing 23 BCF a day, yes, it's cold. Yes, we're going to see freeze offs. Is that a super wet gas? So, but I don't think it's gonna hit as bad as it did during Uri. You also have SoCal pricing well below Waha now, so it's gonna make sense to shut a lot of that gas off that's moving west and start pushing it east if you do see freeze offs. Obviously Waha is kind of maxed out on what's pushing away, but based on pricing right now, it's expecting to shut off some west moving gas and moving east to fill any freeze off drops there.
Yeah. Yeah, I think that regional outlook is an interesting direction now. I think maybe expanding it to the Asia Europe discussion. Mohit, you've been sending some stuff to Drew and I over the past couple of days, or past over a week now, about what's going on in Europe. Maybe if you want to kind of cover that, and we can go into the details.
Yeah, one of the other things I was noticing before the cold hit here is that TTF had started rallying in Europe, and it went from roughly $9 to a high of about 14.5 this morning, um, which is a very significant move, particularly since it's not absolutely frigid there. TTF had gone from about $9 2 weeks ago to what, 14.5 this morning. And a lot of that was not driven just by extreme cold like here. I think part of it was to try and make sure that supplies from the US do get to Europe. So as the US rallied, they rallied as well, trying to make sure that some of that gas at least gets over there. So it'll be interesting to see how that dynamic plays out if the weather here flips. And I know, Alex, you were talking about Asia, Asian pricing also going up. I think, again, they're trying to compete for the same gas. So anyone who's short gas and dependent on LNG will try and make sure that pricing goes up to continue getting the supply they were expecting.
Yeah, Europe had a very interesting combination or interesting start to the year because you have the US-Iran geopolitical tension kind of kick off again, threats of US intervention in response to the economic-related unrest in Iran. And with that, there's the corresponding fears about disruptions to energy flows through the Strait of Hormuz, primarily obviously going to be affecting crude. But for Europe, especially as that reliance on LNG grows, then I think that reaction is also going to grow. And we saw that definitely coincide with the geopolitical condition there. And as that was resolved, then you get the weather impacts start to kick in. And specs in the European market, they came off quite a bit, or shorts specifically came off quite a bit for TTF in response to that, even though the weather outlook, the immediate weather outlook for Europe is not particularly bullish. It looks like we're going to have, pulling it up right now, we're going to have maybe some mild cold anomalies for kind of the balance of this week, but then we're looking slightly warmer than normal for most of Western Europe for the kind of 6 to 10 into the 11 to 15. So not anything significant, but as you said, that increasing reliance on LNG is particularly interesting as well because of the European storage levels. We started the withdrawal season quite low relative to previous years in Europe, and that trend has really accelerated through January. And right now, EU total gas in storage sank to about 47-48% of capacity. And just for context, the trailing 5-year average for this day is about 64-65%. So quite a bit below typical levels. In Germany, Europe's biggest economy, it is even more aggressive. You have storage down to basically the 41st or 41% right now, and that seasonal average is about 65-66%. It's pretty low with plenty of winter remaining, and I think that has definitely exposed some of the risks in the European market, and then for Asia, just remaining competitive in there as well. Drew, I think maybe one thing that it was interesting to hear you talk about this with clients, but just that balancing mechanism that LNG can provide, and then as we go into kind of the first half of 26 or the remainder of 2026 with new capacity, kind of the near term to midterm kind of LNG discussion. I think there's some stuff in there that's pretty interesting.
Yeah, I mean, you hit the nail on the head. We're at 20 BCF LNG, give or take a little bit. And, compared to even last year, weather events at 14 BCF, I mean, this is a substantial more demand that can be turned off. And, some of these guys have firm contracts that they can't just shut off and sell back into the market. I mean, if things got crazy enough, they definitely could. But a lot of them are going to be trying to push or delay cargoes into next week, even if to capture a couple days of some higher pricing. So, I think these guys are traders as well, and they're going to take advantage of that if they can. So I think we saw that today with the pressure on the 3-day strip going from 18 to 14. Someone's going to be selling that out there, and those guys I'm sure are taking advantage of it. Near term in 26, obviously Golden Pass has been the one that's been looming. Ramping up train 1 earlier this year, train 2 later this year, and train 3 and late this year, early 27. So it'll be interesting to see how that ramps, what that looks like over the year. We're expecting kind of, I think, 2 to 2.5 BCF of incremental demand from LNG this year. Still great, 2.5 BCF. It's not compared to 25 that had 6 BCF of demand growth, but That said, there's a lot more coming in the first half of 27. So we're going to see, a slower year this year on the LNG demand side. Just getting ready for what's going to happen in the 2027 year and 28, where you start to really pick up again and start chopping away at some higher growth in 27, 28. I think we have right now 34.5 BCF of FID capacity through 2032, 2033. It would expect more in the next couple months here to get FID. We'll see what facilities and how far we can get, because eventually you get to the point where how much LNG capacity is too much. So it'll be interesting to see what happens early this year with FIDs. I know a lot of LNG companies are trying to take advantage of the current administration, trying to permit as much as they can and FID as much as they can in the next couple of years before there's a potential switch in administration again. So it'll be interesting to see what headlines come out the next little bit. Definitely need that production to grow, as we mentioned earlier. I mean, you got 10 BCF of Waha coming online. Some of that's going west, some of it's going east. Production's going to still have to fill that. So you're going to need to price Waha area high enough, whether it's oil or gas, to start filling some of the long-term LNG needs. And then, the ever-looming data center need that's ever harder to model and know what's real, what's not real. So I think we'll see a lot of that this year on plants starting to ramp up, come online, actually take molecules and what it does to the overall demand of the country. Because, I mean, it's going to be impactful. It's just how quickly is it impactful?
Yeah, I think that combination between LNG and the data centers for 2026 is especially interesting. You have mostly second half centric, but between 3 and 6 BCF a day of new production that's likely to come on by the end of the year. And so I think the timing between each of these different factors will be particularly interesting for the transition into summer, see what that data center demand looks like and kind of get a gauge of what's real and what's maybe hype, as you mentioned. On the LNG long-term capacity growth, I think that the other question that we've been running into is, what does that mean for volatility and some of these other downstream effects when we have the storage capacity not kind of keeping up with the LNG capacity growth? And Mohit, you had some interesting thoughts on some of that this week as well.
Yeah, that's something which is going to become more important for producers to keep track of, is not to get caught up with the hype, because if there are outages, and there will be outages, the downside will become much more magnified because you're losing a lot more of what you're depending on for demand. So as 10 or 20 or 30% of the demand is LNG, if part of it goes out, you've got a lot more room to run to the downside. So hedging and protecting yourself becomes even more important.
Hurricane season gets a lot scarier with 30 BCF of demand to the gas market. So we haven't had a big impact in a couple of years. So it's something we always warn our producers, end users, to potentially take advantage of price drops for the end users. I mean, we haven't had an impact in a while, so we'll see if hurricane season gets a little more active this year. We dodged the bullet, I feel like, last year and didn't really have that many storms. So
Right.
We'll be ever more increasingly dangerous for the gas market as we enter that season.
Yeah. And what makes it worse is that's a time when you're already potentially running into fuller storage, less capacity gets solved. So that all gets magnified even more. So yeah, again,
I think we might need more storage capacity in the lower
maybe.
US. I think some people are trying to solve that problem, but not quick enough. So, volatility will definitely be here to stay, up and downside in certain times of the year. So it'll be interesting.
Yeah. Well, I think that's an awesome little discussion. I think we can leave it there. I think there's going to be plenty to discuss when we look back at the next few days of cold and just see really what the damage was. And so we'll return with an update on that. And anything else that you guys want to hit on before we sign off?
Just stay safe, and hopefully Winter Storm Fern, I think the name of it is impactful, but not too impactful. And everybody stay safe out there.
Yeah.
Stay safe,
Goldilocks.
and from my perspective, stay warm.
Yeah, exactly. Awesome. Well, we'll see everybody again next week. Thanks for joining us on the Energy Desk. Please keep in mind this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.